Hello everyone, Chris LaChava with RE/MAX Heritage Professionals, and I want to talk a little bit about the mortgage rule, the 80-20 mortgage rule. Basically what the 80-20 rule is and related to mortgages, that generally speaking, mortgages are based on putting 20% down. So if you don't put 20% down, that typically means you're going to be paying mortgage insurance. Well, what is that? Mortgage insurance is often a very misunderstood term in real estate. Basically, when you start out with the reason that lenders require mortgage insurance when you put down less than 20% is that basically there's a higher risk for the lender of the loan going into default and then ultimately into foreclosure. Mortgage insurance offsets the risks of lenders' financial loss in those situations. So the 80-20 rule it's basically loan to value ratio. So it's not just if you ultimately borrow more than 80% of the home's value, so you're putting less than 20% down, then basically you're going to be paying mortgage insurance. How do you get rid of mortgage insurance is that you have to have more than 20% equity. And basically that can happen because the home increases in value or because you pay a certain amount of principal down. Okay? So that's important to keep in mind. Basically, with less than a 20% down payment, you're going to pay mortgage insurance premiums for coverage that reimburses the lender for its loss if you end up defaulting on the loan. Okay, so it's an additional charge. It actually increases your monthly payment is what it does. And it can be for conventional as well as government-backed loans. So it's not just FHA and VA loans, but if you do a conventional 3% down loan, then you're also going to be paying mortgage insurance. Depending on the loan program and the mortgage insurance requirements, you may be either paying the premium up front, monthly, or both. It just is going to depend on the lender and the different program. On conventional mortgages, basically those premiums are paid to the bank, the third-party lender. And with government-backed loans like FHA, VA, USDA, they're paid to the insuring government agency. Okay. Some people confuse mortgage insurance with mortgage life insurance, which is basically if something should happen to you, your mortgage gets paid off. It's not the same thing. That's something you would take out separately on your own. It's not mortgage insurance. Sorry, my puppy seems to have a little anxiety today and he's whining a little bit. So that's a little bit about mortgage insurance. So again, how do you get the PMI removed, the mortgage insurance removed, is generally speaking when the principal balance is paid down to 80%. So you now have the 80-20 rule, okay? So again, it's worth, when home prices are going up, it's worth periodically having your home appraised to see if you potentially can get rid of that private mortgage insurance. That's something to keep in mind. I hope this information is helpful to you. If you have any questions about this, please reach out to me. I can connect you to one of my great lenders. One of the things I do want to clarify, actually, before I move on, is that FHA, generally speaking, your MIP stays, your mortgage insurance stays in place for the life of the loan if you have less than 10% down payment. Unless you refinance. Now, when you refinance, you may be able to refinance to a different loan, and that would be the way to get rid of it. Anyway, there are some options. If you have to pay mortgage insurance up front, it doesn't necessarily mean you're stuck that way. There are definitely some options, but you need to talk to a really good lender to figure out what your options are. Hope this information is helpful to you. Please subscribe to my YouTube channel. I love to have you on here. Remember, if I can help anyone in Central Florida buy or sell a home, I would love to do so. Thank you very much. Have a great day.